Go ahead.
All right. Welcome to Real Estate Accredited, where we go over the nuts and bolts of real estate investing. I am your host, Jeff Rodriguez, joined by my co-host, Philippe Schilligan. We are co-founders of Boost Capital Group, a real estate investment firm that helps busy professionals invest in commercial real estate assets. Today, we are here 7 p.m. every Thursday, Eastern Standard Time. So always welcome to stop on by. Today, Philippe Schilligan, what are we going to be talking about today?
Hey everyone, thank you for joining. Today we're going to talk about series Unlock Wealth in 2024, how new developments impact in-place multifamily.
Just step back and go over the disclosure real quick, if
Oh,
you don't mind. Just a little bit quick disclosure. Boost Capital Group does not provide tax or legal advice. The material here is provided for informational purposes only. It should not be construed as investment advice or an offer solicitation to buy or sell securities. All right, now that we got that out of the way, let's continue.
all right. So new developments and how they impact in-place multifamilies. Obviously, in-place multifamily is going to be, and the success of those properties, they're going to be a factor of supply and demand on the market in the terms of number of units. It's very important to keep an eye on new developments. And obviously here I'm referring to new multifamily developments and understand how that's going to impact any property that you're considering buying or you are operating. So today we're going to talk about the effects of new developments. What's the absorption rate, population migration trends, as well as many other trends actually that will go a little bit in depth, and we'll conclude this presentation with the secrets of what to look for when it comes to new developments. So what are the effects of new developments on any property that you're considering buying or you own? There will be potential rent and vacancy impacts, meaning, and when it's a positive effect, it could be tied to revitalization of an area, leading to higher rents and lower vacancy. Usually it's tied to a major attraction development in a particular neighborhood and therefore attracting a lot of people to a particular area. And if you own a property in that particular neighborhood, then you can benefit of the higher rents, lower vacancy because of higher demand. But usually you're going to end up with supply being greater than demand because of new developments, leading to lower rents and higher vacancy. And why is that? It's just because you're going to have increased competition, right? And the new completions of units, they're going to offer concessions to attract new tenants, meaning that whatever rent on this new build, they may be very similar to a Class B type of property, right? A little bit older property. And then so you have all the tenants of the B property moving to the Class A property. And that's what I'm representing here in the last bullet point. You may end up with a shift of tenants moving from basically, it's like a domino effect. The Class B tenants will move to the Class A property, and the Class C tenants, they might move in a Class B property, etc., etc. So next, I wanted to talk a little more about absorption and what it means, right? Because and in a nutshell, it's just the difference between the units that become vacant, market subtracted, from the sum of all units that became occupied during a period of time. So, right, again, we're looking at new developments in a particular neighborhood, and now you're going to have your total number of units is going to increase. So the question becomes, is that particular area capable of absorbing this particular addition of new units? Meaning that, is there going to be people moving in that particular area? That's going to be the answer to that question, right? Can you rent the units? Is there going to be concessions? Is there going to be competition? So next, if we look at this chart that was prepared by Marcus and Milichap and presented in one of their recent webinars on the status of commercial real estate in general, you can show gray bars are the completions, number of units completed in thousands, and the orange line is the vacancy rate. So what's interesting, and I would say typically that's what you would expect, higher supply that we have in the past 3 years, and now you have higher vacancy, meaning that, again, supply and demand. So vacancy being number of units that are becoming available in a particular market, and that's nationwide. So here we're saying from a nation standpoint, there's been a lot of new completions of units. We are looking at 500,000 is predicted for 2024. In 2023, probably around 400,000 units. And that's putting pressure on the vacancy because of this new supply that's made available. But I think it's important to not only look at the broad picture, because now you might say, it doesn't look great. We're not in a good trend. Right now, there's a lot of supply coming, and there's an effect on vacancy, which, again, from a national standpoint, it is the case, but it's certainly worth looking a little bit more in the specifics. So here we are digging a little more on the different regions, and you can see that particularly the South region is the region where there's the most units being completed, right? Compared to the 3 other regions that are shown here, right? The green line is the South, and that's the more than 50% of all the completions of new units. So why is that? Let's try to understand a little more why is that happening, and why there are so many units being built in the South? What's going on there? As if you attended one of the prior calls or watched one of our prior videos, I always talk about the population, and that's always our number one filter when we look at the market. And here it's a map of the migration trends between 2010 and 2020. And in dark red are the areas where there's a lot of migration towards these areas, and it's basically county by county that is being shown. And going from the northwest to the southeast, so you have Washington, Idaho, and Montana, actually.
Yeah.
Those are the two. And here you can see, obviously, Dallas. Did I mention Colorado?
You did.
The Panhandle for Florida and other. And interestingly enough, here you have a big contiguous area like across several states. So the north of Georgia, the east, or more than most of Tennessee, actually, not Memphis, interestingly enough. That is right here. But North Carolina, a portion of South Carolina, and a portion of Virginia, and around Washington as well. So why I'm showing this being like from 2020 is just to emphasize some things, that trends, they take some time to shift. And usually it's going to be years and years for these trends to really shift, especially when you see like the very dark spots. So there's like very strong magnets in terms of population. You have less of those, interesting enough, in those areas. You have some pockets, maybe in North Dakota, maybe they went from 100 to 200 people, that particular county. So that could have been a huge increase locally.
Yeah, probably due to oil up there, something. A lot of this has
that too.
with also also income movement, with Florida being like the 13th largest economy in the world right now. We have a lot of huge economies. I'm surprised though. You look at California, people are leaving California because of the politics. So there's so many things involved in that. You would think that California being one of the largest economies here in the United States next to Texas, there's so many variables though here with this migration.
Yes, and like I said, the trends, they take time to change. And that's why I wanted to bring a more recent map. And in this, which is from mid-2022 to mid-2023, the last data available from the Census Bureau is publishing that. You can see a lot of similarities, some differences, right? Particularly Washington, Oregon is not, people are not moving there anymore. Apparently, they're even like moving out in some cases. The Idaho and Montana still pretty okay, pretty good. Nevada and Arizona. Utah is a kind of a newcomer. Colorado is more mixed, but those are maybe not as much consistency, I would say, in the West region. The Southeast is more consistent. You can see Texas, and maybe not people moving in the Dallas-Fort Worth, but they're moving in the surrounding counties. Same thing for Houston and Austin and San Antonio. People are more moving in the surrounding counties compared to these cities. Same thing, Panhandle for Florida. The same region really across states in between northern Georgia, Tennessee, North Carolina, South Carolina. Actually, there's even, so this on the left arrow here of my cursor, that's the county where I live here, which is a darker green. And a little less, you could see like on the other map, there was a lot of migration in Virginia. It's less the case here, but it's pretty, usually the trends, so here in most of the cases, my point being, in most of the cases, the trends are pretty consistent. They take some time to change. So if we dig a little more on the specific deliveries, specific by market, you can see that a number of markets, so the diamonds, the orange diamonds, the inventory growth in percent. So you can see that in Nashville, Austin, Salt Lake City, Charlotte, Phoenix, and Denver. Yeah, Denver is a little less, but so Nashville, Austin, Salt Lake City, Charlotte, and Phoenix, you are in the 10-15% inventory growth, right? Means that 10 to 15% of the overall supply of units is being built in those markets. There's a huge influx of supply. So those markets, they're going to be hit hard. There's the big gap between supply, the orange diamond, and the demand, which is the household formation, which is this dark blue-gray bar, right? The larger the gap, the harder these markets will be impacted. There's a number of markets where there's a little bit of a gap. Actually, we'll talk a little more about an example in the Dallas-Fort Worth market, so you can see a little bit of a gap. It's not terrible. And I think here the idea is, actually, I have a slide for that with the wrong title. One sec. So what to do here, you want to check out new apartments construction nearby any deal that you're considering in those markets, and discuss with boots on the ground if those properties are going to be, they will impact your property or not. It could be very local. It could be far enough that you're not going to be impacted. It could be that there is a huge attraction, mall, or factory, you name it, something that will attract people in a particular area. And it could be a plus that there's new development. So it is really important to understand the market and sub-market at a very granular level. And in addition to that, you can use the CoStar report, and I'll show an example later on, to have a forecast on occupancy and rent growth to confirm your underwriting assumptions. And actually, let's jump into that right now. And I've just shown here the forecast for the vacancy, but there is, in a CoStar report, you have a similar chart about the rents. And you can see the absorption is represented by the orange bars. The deliveries are the dark blue bars. And you can see, particularly in 2022, suddenly absorption was negative, right? There was and minus 500 units or 500 households. So people temporarily maybe moved out or for a couple of quarters. And at the same time, there were hundreds of units being delivered. So the direct effect, as you can see on the green line, that's the vacancy for Arlington being in the middle between Dallas and Fort Worth. And in yellow, it's the Dallas-Fort Worth vacancy as a whole market. You can see there was a huge impact of the supply that led to occupancy rates in the 10 to 11+%. So which is where we are right now, more or less, at early second quarter of 2024. And so, right, and here, so now you can see at the very granular level how supply is vacancy. And again, there's a similar chart that will show the impact on rents as well. So if you mix like lower rents with higher vacancy, you better have underwritten your deal conservatively and have reserves available to be able to handle this type of event. So last thing I wanted to show is, and I guess it's part of my conclusion points, one way to have an idea of how much new supply will come on the market is to compare the permits, which is the green line on this chart. So permits for housing units, building of 5 units and more. I got this from the Fed website, which is the Fed website actually. And so in green, permits. In dark red, those are the units completed and delivered. So same thing. And you can see that between permits, let's say if we look at the bottom of the market here, or let's say bottom of the curves, permits issuance reached an all-time low of about 100,000 between mid-2009, 2009, and the lower point for the deliveries, it's about mid-2011, right? So there was like a kind of a two years more or less, a little less. As you can imagine, permits to delivery is going to take 12 to 18 months to 24 months. So that's the time frame, makes sense. So same thing here, we had a peak sometime at the end of 2022, early 23, when it comes to permits. And now we can see like right now, it's not showing the Q1. Those might be the Q1 numbers, but you can see the peak. There's a local peak in new deliveries, but you can see that shortly after, there will be a turn in the number of deliveries. So the impact is not as important. And again, if I go back to this chart, you can see that there's these huge peaks of deliveries, but now in the forecast, it's much softer, and it's even softer in 2024, 2025, those are based on actual numbers, and this is like purely a forecast extrapolating data. But you can see that supply and demand is basically going to be aligned, and there is at least at the whole Dallas-Fort Worth market level, that the vacancy will become lower. Not necessarily in Arlington, though. You can see it's staying more or less stable. So on that note, how to benefit of new development trends, or let's say, yeah, that's what to look for. And number one, always population. Then you can look at permits. see what are the deliveries now, what are the permits that are out there, and there's a lag between the permits and the deliveries. And you can always get a CoStar report to have this data available and see what they're forecasting in terms of effect on vacancy as well as rents. And one idea is if you can buy into a market where there is a temporary oversupply, and you can buy where really like the rents are a little bit lower now. So the market is like at this moment a little bit weaker, but it's going to bounce. So there's an opportunity there to find a property. You're buying when the market is a little bit weaker. It's a more advanced strategy, obviously, something to be very careful of and with, and really make sure you underwrite taking into account forecast and as much as data analysis that you can.
Here's the question
So,
about interest rates and new development. How would you say the impact of multifamily, the correlation between new development and interest rates?
let's look here. I know, so it would be interesting to overlay the interest rates as well. And that's it's a very good question actually, because and you can see since 2020 permits have gone up and up and up, right? And 2 years later, we really hit the bottom, local bottom, at least in this part of the chart, at 300,000. It's like, why we don't see any deliveries? There's no correlation. Now you see that happening, like the peak of it that happening now, but there should have been something happening more a little bit earlier, right? And really, it's very counterintuitive. It went down, and that's really because the interest rates went higher, and usually development, you're going to buy the land, develop the land. It's going by phases. Then you do the horizontal development, and then vertical development. There's 2 or 3 phases that are very specific and delimited in scope and time, and you're going to be able to get some financing that's specific to that phase. And if you started to develop the ground and the interest rates are going higher on your construction loan, by the time you start and then you're ready to do the next step, if interest rates are higher, that's going to change your business plan. And sometimes it's better just to put everything on hold and wait until you have things are more under control, and you find a different way to carry on your development. So that's why I think there's a little bit really the peak, the effect of the new permits is going to be lower, actually, the total new constructions, and it is going to turn basically shortly because of the the high interest rates. I hope it makes sense.
So it's definitely very important to keep an eye on the Fed and those decisions being made, even though it's not.
That's right.
At least having that information. So excellent. Thanks. That's a good reply. So that's it for us today. Thanks, Philippe, for the informative presentation. If you want to reach out to us, you can reach us at our name at boostmycapital.com. You could check out the QR code. You could visit us at boostmycapital.com, and please check out multiple videos we have on our YouTube channel, different topics there, and we always welcome new recommended topics. So that's our time. Thank you for joining us, and we'll see you next time.
Thank you, everyone. Please subscribe to our channel, youtube.com at Boost My Capital. Thank you, everyone. Bye-bye.